Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a joy. We start strong with an extended conversation with Torsten Slok of Apollo Global Management. And what's great about him is I can audible 4 or 5 ways, and I do so off a memo he just put out, which goes into my question of animal spirits, nominal GDP, and part of that is the demographic overlay over our societies, plural. Torsten Slok. China's working age population is declining. America's working age population is growing. Discuss, Torsten, that's the heart of the matter, isn't it? We've got a lift, they don't?
Absolutely. So China is facing 3 headwinds. Demographics, because of the one-child policy, is beginning to catch up. It's going to be a significant headwind over the next 10 years. The United Nations is forecasting that the working age population today, which is about 1 billion people, will shrink over the next 10 years to 900 million. In other words, that's 100 million people fewer working in factories, working in the service sector, also 100 million people fewer paying taxes. That is a significant Japanese-style headwind to growth in China over the next several years. Likewise, China is facing some headwinds from a deflating housing bubble. And of course, China is also facing some headwinds from a trade war with not only the US, but also with Europe. And that is indeed some very idiosyncratic sources of why China is weaker than the US is at the moment.
So, Torsten, I think over the last 20 or 30 years, hearing what you just said about China weakening, that would be a real challenge for the global economy. Is that still the case?
That is exactly right. And that's why this has some very important implications. Remember, historically, in the last 15 years, China has accounted for half of all demand for commodities. So first of all, commodity prices are under pressure simply because growth is slowing down in China. Again, partly for demographic, meaning structural reasons, but also for some cyclical reasons that have to do with housing and have to do with the trade wars, both again with the US and Europe. So demand for commodities globally looks a lot weaker across the board. And also remember that Germany is a huge exporter to China. So that also means that Europe is unfortunately also hard hit by this idiosyncratic shock of China slowing down. So it does have some important implications for commodities and the global business cycle.
Torsten, going back to your Excel spreadsheets at Deutsche Bank, can you model out a 5% growth in China? Can you model out a solid Pacific Rim economy?
Well, the challenge is, of course, that if growth is gradually slowing in China, then it will have implications not only for, of course, for commodity exporters and not only for Germany, but also for the neighboring countries. Let's not forget that a significant part of global trade is intra-regional trade flows between China that produces some parts of a good that then is exported to Indonesia, to Vietnam, to Laos, to Cambodia, and then finally ends up being consumed by a consumer in Europe and in the US. So it does have negative implications also for the rest of Asia.
Torsten, I want to talk about what we're witnessing right now. Paul and I were talking about it this morning. Folks, we had a 3 a.m. meeting this morning. Even Lisa attended. My head is spinning with Trump's second administration news. Do you, and frankly, do all of Apollo Global Management, see a cohesive plan here that lifts the American economy, or is it so ad hoc you can't come up with a theme?
Well, I do think for markets, there were obviously a lot of executive orders, and trust me, we studied them very, very carefully because, of course...
Whoa. Has Mark Rowan ever done an executive order at Apollo?
Well, the executive orders here, of course, for us in markets is all about trying to figure out what are the implications for macro. And I do think there are 3 areas where things will have implications for macro, and that is tariffs, of course. It is about immigration. And it's also about potentially lowering corporate taxes for domestic manufacturers to 15%. If you impose tariffs, it's inflationary. If you restrict immigration or do deportations, it will also be inflationary, in particular in the sectors where the 11 million illegal immigrants work. According to Pew, they work in agriculture, in construction, and in services, including restaurants. You will see wage inflation in those sectors if you do serious deportations and if you do serious restrictions on immigration. So both tariffs and restrictions on immigration will probably have some lift to inflation. And the problem for the Fed and for the economy and for markets is that inflation is already around 3%. We're just not quite yet at 2. We're more at 2 than when we were at 9, but we're still not quite at 2. So if you now add policies that run the risk of lifting even modestly inflation, it unfortunately is because the starting point at 3% is just creating all these problems in long rates, and of course also all these problems for the Fed.
Jamie Dimon is speaking in Davos as we speak, Torsten, and he's out there as it relates to tariffs. While tariffs may cause some inflation, he views them as an economic weapon. Are they a valid economic weapon, do you think?
Well, I mean, whatever the exact motivation is and whatever the exact outcome will be, it is absolutely clear by definition that if you raise the price of all goods that come from China by 60%, and therefore everything that we buy in the supermarket will increase in very round numbers by 60%, it will have a direct hit to inflation. So to what degree we get that, and now Trump talked about also that we might get before the end of next week some tariffs, 25% on Canada and on Mexico. It all remains to be seen exactly. Betting markets also have a view on whether this is happening or not. We study every aspect of this, and we try to exactly make an assessment of what's coming and what might the implications be. But the bottom line is that it will have some implications for inflation, and that's exactly why rates and the term premium have gone up so much, because the implications could potentially be quite serious.
Torsten Slok with us with Apollo Global Management. We welcome all of you on your commute this morning. Be careful out there. For much of the nation, 1977 cold. Good morning to Chicago, 7 above zero. On YouTube, subscribe to Bloomberg Podcasts after your commute, in your office, at your home. YouTube is the best way to get the handsome, tanned and rested Paul Sweeney, or the tanned and rested Lisa Mateo, or the pasty white puke Tom Keene as well. We continue with Slok of Apollo Global Management.
Torsten, let's step back here and just think about this U.S. economy. What are the biggest headwinds here? Because it seems like, certainly relative to the rest of the world, the U.S. is doing very well. What are some of the headwinds you see out there for this economy potentially?
Yeah, this is very important, because if we just spoke about what the headwinds are to the rest of the world, namely China is slowing down, Europe, on top of China slowing down, is also experiencing some headwinds from energy transition. There's also some challenges with politics in Europe. We will have a German election in February. We'll have a French election in July. Of course, when they are settled, then we'll have some more idea about exactly what direction Europe is going. For the U.S., it is the case that at the moment there are actually some very unique tailwinds. First of all, U.S. consumers are not very sensitive to interest rate hikes. We just found out over the last 2 years that even though the Fed raised rates, because 95% of mortgages are 30-year fixed rate, it really ended up being that the transmission mechanism of monetary policy in the U.S. was quite muted, simply because consumers were locked in their mortgages at very low interest rates. Likewise, in the U.S., we now have a data center boom that is adding, in round numbers, around 0.2% to GDP growth every year. And finally, we also still have fiscal policy, even before Trump, coming from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. So the tailwinds to the U.S. outlook are quite unique. So therefore, to your question, I see more decoupling where the U.S. is doing well because of some unique sources of growth in the U.S. And the rest of the world, unfortunately, continues to do less well because of some unique headwinds that are not headwinds to the U.S. economic outlook.
Torsten, it seems like almost a bipolar American economy. It is just so odd here how I guess we've got a consumption boom. I guess the haves do better and better. Do you see the compendium of statements by the new Trump administration leading to a broad economic growth? Or does it stay, and I'm using this term not medically, but does it stay barbell or bipolar?
You are absolutely right. If you look at delinquency rates on auto loans, delinquency rates on credit cards from the New York Fed, it tells you that younger people are falling behind at a pace that is faster than older people. And why is that important? Because when I'm young, I have more debt. I have more debt on my car, more debt on my credit card, more debt on my student loan. So that's why younger households are falling behind, because they are harder hit by the Fed raising interest rates. Likewise, you also see savings for low-income households are very low, whereas savings for high-income households are very high. So to your question, this bifurcated situation where high-end consumers are doing well and low-income consumers are facing headwinds, I think that overall, this, of course, economy, if we continue to create jobs, it will benefit everyone. if we do begin to see interest rates go down, we will benefit everyone, including low-end consumers who have more debt. So I do expect that a stronger economy is something that will be benefiting everyone across the income distribution.
Torsten, to tariffs and on the magnitude, Paul Krugman with us recently really discussed the harmlessness of 2 or 3% tariffs. Where is the Slok level where tariffs really begin to affect our culture and our macroeconomics?
Well, if you look at the tax foundation calculations, they show that if you do 60% on China and 25% on Canada, Mexico, and 10% on Europe, you will see the level of tariffs go up in aggregate to 18%, which is the same level as we had in the 1930s, which of course was a very bad economic situation. So if you do get tariffs that are going all the way up to the highest levels of everything that has been talked about, then I do worry about what the implications could be, because the simplest way that I think about it is that everything that I would buy in stores, if that goes up by 60%, and if my new car on average would go up by $3,000, if you have, broadly speaking, every good that we import goes up in price, it would certainly have the implication that inflation would be going up and demand, and therefore sales of goods that are imported, would go down. And the economy is just not able to quickly adjust and produce these goods at home. So that would run the risk essentially of creating inflation at the same time, also as a slowdown in GDP. So I do watch, and we spent quite some time looking at exactly at what are the implications and what areas is it where tariffs are being talked about.
Torsten, talk to us about the consumer here, right here. It seems like the consumer here in the U.S. has a job. Wages are rising, maybe even rising faster than inflation. Talk to us about the U.S. consumer here.
Absolutely. So if you on your Bloomberg screen type Redbook, same store retail sales, this is a weekly data series, you will see that the weekly data, which comes out every Tuesday at 9 a.m., is still showing a consumer that's growing at a very solid growth. The growth has been around 5-6% literally for the last 12 months. And this is on a weekly basis. That compares same store sales for retailers this week compared to the same week a year ago. So in aggregate, consumption is very strong. Another good Bloomberg trip, if you type ECFC Go, you will see that what does the consensus expect for the consumer for the next 6 quarters? And the answer, Paul, to that question is also that we should also expect to see the consumer continue to do well, simply because of we still have tailwinds from high rate wage growth and still strong employment.
Dr. Slok, 20 seconds. Is the Fed meeting end of January going to be a snooze fest?
I think it will have a risk of being a snooze fest. They have already signaled, and markets are pricing a 98% likelihood that they will do nothing. But the challenge, of course, is, as usual, the press conference. What will Jay Powell say? All these risks that we're talking about here, it's really complicating the Fed's job very significantly.
Torsten, thank you so much. Your notes in the morning and along the day are hugely valuable to all of us on Team Surveillance. Mr. Slok with Apollo Global Management.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Right now, Steph Guild with us here to get the market open with Robinhood. I don't get much exuberance here. It's just a lift. What do you see at Robinhood?
We see a lot of enthusiasm for investing in the market, but we continue to also see our customers trade around the volatility of the stocks. So, for example, Tesla was up a lot, in December, and that was a source of funding for adding to other places that maybe had not done so well.
How did you kind of, if at all, change kind of your investment outlook for 2025, given what happened with the election and kind of what we now know? Did anything really change for you guys?
Nothing's really changed. Like, it's actually been so far working out the way we had called for. I'm a little worried about rates going above, like I said, around the 4.5% mark with risk to 5%. It got to 4.8. It's kind of back down again. It could go higher than 5.
To cut to the chase, your shop, remember the SPAC idiocy or the memes? Is it memey now? I don't feel like it is.
I don't think it's memey at all.
Why is it not memey here with the levels we're at?
Because our customers are investing in companies that have true earnings growth.
What's a typical Robinhood customer? Who is a typical Robinhood?
So we actually put all these stats out for Investor Day, so I have some good ones in my head now. We're about 50% millennials, 20% Gen X, and then the remaining 30% amongst Gen Z and younger. So
it's like boomer free.
Boomer free.
Well, Gen X, depends on how old you are in the Gen X.
Talk to someone young like Paul.
60% male, 40% female. We have a mix of income levels, sort of on the younger side. About 60% of them are married. It's kind of like it's the next generation and beyond.
Or did they focus?
Does that mean 40% are divorced?
Yes, exactly.
20% said they were divorced.
Okay. So what are they more on the growth side? Are they overweight, maybe some of these Mag 7s? What types of stocks do you find them typically investing in?
Yeah, at the top of so we have something called the Robinhood Investor Index. Okay. And at the top has been consistently Tesla.
Okay.
And I do think that there's just a cultural, true belief in Elon and what he does. I think beyond that, then you look at what I call sort of, at least for a while, the utility companies, like Apple is a utility company. And it's kind of been showing that to me from a return perspective recently. But then you've got Microsoft, NVIDIA, and then you've got some, belief in electric vehicles beyond Tesla. About 20% of the index has been invested in various electric vehicles. Our customers' average median age is 34, so they do have a longer time horizon to make their investments. And they are believing it, Ford has been at the top of that for a while. Disney, because Ford is trying to get into the EV game and grow their business. And then, at the bottom, you've got lots of stuff that come in and out.
I want to get to this after we open the markets.
Yeah.
But are you a bull now? Are you a convicted, in terms of your strategy?
My call since early December when I put together my outlook was 6,500 on the S&P. That's at the lower end of the Wall Street estimates.
Fair.
Okay. More bullish on mid caps. So far year to date, mid caps have actually been outperforming large caps, although maybe after today and after earnings that starts to change. I think you can't count out the large cap tech names. They just have so much clout in this administration and so much power that comes from money.
We're the Steph Guild of Robinhood. On the Mag 7, they just continue to, even if they've got a high multiple, they earn into their multiple, right? Is that simple?
As I said, before we kind of got to the open, I think they just have so much clout in this administration. They have a lot of cash on their balance sheets. They are dominating the AI innovation. It's hard to see when this could stop, other than just we haven't really gotten to the tough stuff when it comes to our deficit and interest rates. And that to me is the headwind. The other headwind is just energy, being able to have enough energy for all the infrastructure that needs to be built.
I mentioned that earlier.
Yep. Yeah. On the mid-cap space, this is a name near and dear to Tom's heart, the Gap. Why is a Gap screen well for you guys?
It's certainly inexpensive relative to its history. It's been in the doldrums for a long time. It's at 10.8 times next 12 months earnings, but it's also cheaper than its peers. I just think the new CEO came in 2023. He's had some time to start turning things around. They are paying down debt. They brought in Zach Posen to kind of influence what product they're going to put out. It's just, and also technically it just crossed over its 150-day moving average over the last 1 year. So there's just some tailwinds, I think, behind it. It is still, I'd say, a little bit of a show me stock because the company is in the retail sector that is competitive. About 60% of its earnings come from Old Navy, so a lot of that will depend on what happens there, which is the lower price consumer space.
It's got a $9.3 billion market cap, and it's over the past 12 months up 30% there. So when you think about a name like the Gap, is that your call? Does that reflect your call on the consumer, or is it kind of specific for the story?
I think it's both. I really think we're in I keep saying this all the time, in a stock picker's market.
Okay.
Peter Lynch famously said, the person who picks over the most rocks wins. And I do think we're in that environment because we have higher interest rates are going to stay stubborn.
Okay.
If you look at over the last 30 years, the Fed did a paper, 42% of earnings growth over that period from 1989 to 2019, what came from tax cuts and interest rate drops. Mm-hmm. And so I think we're in an environment where company management decisions and what they're doing with their company, how they're looking to grow it matters more than ever.
Thank you, Steph. It's been great. Steph Guild, thank you so much. With Robinhood this morning.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Because I never watch Netflix. I'm like the least qualified person.
You're not a Squid Game guy?
No. Lisa, do you watch Squid Game?
No, I do not. My kids do. It's pretty gruesome. I don't know.
Robert Schiffman's in it, I think.
Oh, I think maybe he's got a cameo. Robert Fishman joins us, senior research analyst at MoffettNathanson, our good friends over there, doing some great work on the media, entertainment, telecom business. Hey, Robert, I was just reading your research note from this morning. Like a lot of analysts and a lot of investors, this company continues to surprise on the upside in terms of its subscriber growth. What did they report this quarter?
Yeah, good morning. Thank you for having me. So remarkably, they reported about 19 million net subscriber additions last night, which if you take a step back and really try to understand how big of a number that was, at the beginning of the year, we were forecasting the company to add in last calendar year about 20 million net additions. And they ended up doing that almost in one quarter. And for the full year, essentially doubled our entire forecast of over 40 million for this year. So it's truly remarkable.
Why isn't there another Netflix? Don't they have a formula people can copy, Robert Fishman? I don't see it out there.
Well, the other media guys are definitely trying, but it's not a easy template.
Well, I don't understand. I mean, if Columbia Records has a hit with Bob Dylan, you go out and find the next Bob Dylan. Why can't they copy Netflix?
I mean, Netflix has a lot of advantages, and probably the biggest one is being first and the size and scale that they've gotten to, especially outside of the U.S., is nearly impossible to compete. Again, we still think some of the other traditional media guys still have a ways to go, but are at least on the right path. But it's clear that no one is catching up to Netflix at this point.
So given that backdrop, Robert, and to follow up on Tom's question, I kind of, as I look at the landscape, I say, all right, Netflix, obviously, they are the leader. I'm going to give Disney a pass and say they're going to they do have a very profitable business and will get even more so. So they're a player. But after Disney, I don't know how this thing shakes out. Do you expect to see, for lack of a better word, subscale players like a Paramount, like a Warner Brothers Discovery? Did they have to kind of consolidate, do you think?
Yeah, I mean, we definitely think it's inevitable that these other streaming platforms that you're talking about need to come together because the size and scale that they're at today, frankly, just can't really compete. And what it really comes down to, again, is the U.S. versus the international business. And I think what Netflix has proven so well is they have the ability, you were talking about Squid Games before, to bring this content in from around the world. And most of the traditional media guys are really just focused on U.S. content and exporting that outside to the international market. But the benefit that Netflix has is creating all of this content outside of the world. And a lot of it is really hitting well in the U.S. as well.
Robert, your report's just pristine. I don't want to get into the numbers because it's too cold outside. But I do want to look, Robert Fishman, at you're saying I'm enthusiastic, I lift my price target, but I'm neutral until I see the 10K filing. What's the 10K filing, and why are you waiting to read that?
That's a very interesting question. So as far as the 10K goes, what we like to do is the annual report basically from the company. It just gives us a time to take a step back, really reassess as far as, again, what just happened this past year, what we got right, which in all candor was not a whole lot with this company because they continue to blow it out of the park. And so what we try to do is really revisit our forecasts and try to understand how much more upside is there to go and try to value the stock appropriately.
Robert, let's talk about sports here. For most of this company's existence, they've said we are not going to get into sports business, the live sports business. But quite frankly, I'm just waiting for the press release to come when they actually have an NFL package. Talk to us about sports and Netflix.
Yeah, well, I mean, as you're alluding to, they already have NFL games. So as far as NFL package, we agree that that is inevitable. The NFL does have some time with their current contract, so that there's an out clause towards the end of the decade. But as far as the current strategy for Netflix and sports right now is big events. And they're clearly doing that very well. That they again started out as big as you could imagine with the Tyson Paul fight, and then went to the NFL Christmas games. They just got the rights to the Women's World Cup for starting in 2027 and 2031. And so they're clearly adding to their portfolio, but they're doing it in a very strategic way, where they're building out event-tized sports content.
Are they a friend or an enemy or a frenemy of the National Football League?
I think they're going to be a big friend to the NFL, and the NFL is going to look to continue to bring them in many different ways to reach their audience outside of the U.S. and grow the international audience, which is a really critical piece to the long-term growth of the NFL going forward.
I mean, I'm trying to get to the weighted average cost of capital on this dog. I can't get there right now. Looks like the program's down. We'll have to see on that. I don't know. Absolutely fascinating. Robert Fishman, thank you so much. Great summary as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Your daily look at the front page is the Lisa Mateo moment. Lisa Mateo, what do you have?
Well, since there's been so much talk about TikTok, right? Who's going to buy it? What's going to happen to it? I found a little sidebar story from the Financial Times about the workers. Sources are telling them that the workers at ByteDance who relocated from China to Singapore, they were told in a memo that they have to pay tax to their home country. And if they don't, that they risk kind of losing that ability to cash out on the stock options. And stock options make up a big chunk of their paycheck. It's about 1,000 employees or so could be affected by it, but a tax difference could be as high as 21 percentage points depending on their individual salaries.
So if they move to Singapore, does that get around our angst about China? I would guess no.
I don't know. I mean, it's fluid, as they say.
Are you on, Lisa? Are you on the red whatever, the new one?
Red note? No, the red note? No, I am not.
Is the FAM?
No, the FAM has not switched. They're still on the TikTok. It brought it when it went dark. There was a bit of a panic.
There was a bit of a panic
with the children.
Do your kids hide that they're on TikTok?
My daughter did for a while.
Yeah, because kennel fee's on TikTok like glued to it, and you know the dog takes the phone and puts it underneath the food bowl. Next.
Okay, this is China, right? Trying to boost their consumer spending. So this was an interesting story about how it's welcoming back Hollywood movies in order to do that. So it's allowing foreign films to be screened, old and new ones, R-rated Hollywood movies, films from other countries like India, Japan that weren't allowed there before. But it's a lot more. And the reason is because when people go to the movies, they spend more. And a lot of their movie theaters, which I didn't realize in China, are located in shopping malls.
Right.
So people go and they just spend,
buy food,
and that's what they want.
Kind of and I'll tell you, this is a big deal for Hollywood because pre-pandemic, for big blockbusters, these $200-300 million box off, big spending things, it had to play well in China in order for it to really be globally successful. And then for the last 4 or 5 years, no, for a variety of reasons. A, the pandemic. B, China just cracking down. But now it's opening back up again, and that is huge for Hollywood because that's the second biggest box office outside of North America is China.
All right, and airlines, they had a rough 2024, as we know. But this is a Wall Street Journal scorecard. It has a look into who came out on top. So they ranked about 9 major U.S. airlines. It included things like on-time arrivals, flight cancellations, delayed baggage handling, all of that. So at the top was Delta. It actually stood out in nearly every category. The only thing is that they had this data that went through only till May, so it didn't include the CrowdStrike outage and passenger complaints in there. So that wasn't affected, but it's the reason why they say their tickets are often higher than other airlines. But it was a close race. Southwest just 1 point behind.
Really?
Alaska Airlines came in third, and the worst was actually Frontier Airlines. Came in last place.
And my United sitting smack in the middle.
In the middle.
Okay,
Yes.
very good.
So much of it to me is the airport. United you sit on the runway at Newark. I mean,
It's Newark, yeah.
You know, it's like
It's
a
got,
trillion
if,
highway.
knock on wood, it's been better the last few times I've flown,
Okay.
so we'll see how it goes there.
Lisa Mateo, thank you for the news. Greatly appreciate that. The newspapers today, thank you, IBKR, for your support.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.